TheoTrade. This is Don Kaufman. May 5th, 2023. Minutes left inside of this trading week. And wow, what a week it's actually been. You want to talk about some market volatility? You got some market volatility. I mean, look where the S&Ps are right now. SPU's up almost 80 handles. 15 minutes left to play inside of the period. Look, we saw some heavy sell side activity earlier in the week. We got a bid back under us. We've had the Fed, we've had the jobs number, we've had Apple, and yet, look, the S&Ps, they're still down on the week. The QQQ is actually up slightly. Nasdaq is up slightly on the week, but the S&Ps are actually off for the week. We've got banks to talk about. I mean, you name it. We have been thrown a lot in this last week of trade. Let's start to actually break it down. One of the things I wanted to start with is actually the jobs numbers today, which came out pretty good. I mean, the jobs, they beat. So the jobs number's up, and it used to mean that good news was bad for the marketplace, but in this particular case, look, I can't, and I really want to, emphasize this. I can't say that the jobs are what led to the rip your face off rally today. I mean, look, we started the day. This is actually pre-market here. It's 8:30 in the morning Eastern time. That line across your screen is the 4106. And one of the reasons I'm highlighting just the jobs number is because the 4106 inside of the S&P futures is absolutely a pivotal level. And what's actually occurred over here is the jobs number hit initially, knee-jerk reaction to the downside. We ripped back to the upside. Basically, at the cash open, we exploded back. Looked like some short covering caught fire. All of a sudden, we're in the midst of a gamma squeeze. My gamma is getting squeezed right now. The S&Ps, as I said a moment ago, are up some 80 handles. With all of that being said, you have to recognize, and again, I love talking about stuff like this, you got to recognize what you've actually seen this week. You have to recognize that the entire week, the expected move, all right, that's for all 5 trading days, and this is the expected move inside of the SPX, is supposed to be basically $72. We've had a multitude of trading sessions this week. We've seen over a 70-point move. Go figure, right? I mean, what you're basically getting is implied volatility in the short duration. And again, this is critical, and I just wanted to kick off the weekend update with it, okay? Because again, it's critical to read into the fact that implied volatility in the short term is being way overcome by historical volatility, which basically implies, right, and I'll just make this very clear. When I say implied volatility basically sets expected move, right? Doesn't matter like the percentage over here. Oh, whatever, implied volatility is 15%, who cares? Implied volatility is saying the market should move $72. Actual move on a day-to-day basis, we've seen 80 points of range, we've seen 90 points of range. It's just huge by huge. I mean, look at this. You have about a 90-point range from the absolute low to the high today. And I got to tell you, okay, for those of you, if you're looking at the shorter duration options like 0 DTE options, you want to be a buyer, not a seller of those 0 DTE options in volatility like this. And that's, again, it's one of the reasons that on this weekend's update, we're talking about what I term the dangers of heavy volatility and an extraordinarily narrow range. So let's jump right into that. What is the range? So we take a look at the S&Ps, and we're actually going to jump over here. Once again, my favorite chart lately has been the 30-day 1 hour. Look, I'm no market technician. I don't even play a market technician. It's not that I'm a market technician or not a market technician. What I'm looking at when I talk about a narrow range, again, and this is something I've mentioned every single weekend, all of the trade that you're seeing transpire is roughly speaking from 4,100 up to basically 4,200. You have to realize, rationalize, if you will, it's a 100-point range. We almost did 100 points today from absolute low to where we presently are. It's almost 100 points today. And yet we've been in this range, okay, for over an entire month. The issue at hand, though, right now, okay, it isn't just like the moves that we're seeing. The real issue at hand right now is just, let's start with the mere fact that how long have we actually been, again, in this range? And the answer is, well, considerable period of time. It's over a month. When you trade at the same location for a longer period of time, okay, forget about what you think about, the market's going up, the market's going down. Check the baggage at the door right now. Okay, this is not about that. What it's about, all right, is open interest. Okay, open interest, not necessarily in the S&Ps. So what products out there mirror these S&Ps? So you have the ES, and that's going to accumulate open interest. You have the SPX, and that's going to accumulate open interest. You have the what? Okay, probably the most prolific product out there, the spiders, and that's going to accumulate open interest. Okay, you've had products like the VIX, and that's going to accumulate. I mean, basically, in effect, all of these are the exact same thing, right? So whether it's the S&Ps, the SPX, or the spiders, all of them are accumulating open interest. The longer you stay at one level, like, can you imagine how much open interest is actually accumulating at these levels? And I try to explain it like it's almost like a snowballing effect. That snowball just keeps getting larger and larger. Okay, people, we've hit critical mass. Like it's one of the points I want to make. And that is like really, that's the whole topic for this weekend. Like you're getting heavy volatility in this marketplace, but you're in an incredibly narrow range. What did you think was going to occur? And I'm saying it before we've even broken the range. Like, what do you think is going to happen coming out of this range? Okay. And I'm going to tell you exactly what's going to happen. It's going to be downright violent. And if you try to handicap right now which way we're going to go, no one has any idea. It's the hedging activity. We get right up here. This level, by the way, is 42.11. We could explode off of it. We get right down here at the 4106, we were just there. We were there this morning. We could explode below it. And I'm actually going to give you, okay, even more critical points. And I cannot stress this enough that it's one of the dangers. And it's one of the things like this actually, I got a little gun shy this week on trading. I'm going to tell you guys right now, I've been in this business now. It's 25 years. It's very rare do I get a little shy and not want to step to the plate when I see a pretty good opportunity, because I'm going to tell you right now, some of the risks outweigh some of the opportunities. And I am getting a little shy at some levels, which I'm going to talk about here momentarily. So I wanted to start with that is that you have this range, and the range, it just keeps building and building and building. Okay. And we've hit what I would actually say is critical mass. How do I know something big is, afoot? First of all, frankly, I'm shocked that we didn't crack right here. Okay, I'm shocked we didn't crack back here. All right, what are these levels over here? There is a level somewhere in and around 4070-ish. Okay, and I don't have it pegged, but 4070-ish, we're going to break through. We could absolutely collapse. The next thing you know, you're sitting at 39.31. Same is true to the upside. And again, I do not want to put weight to the upside. Look, I am longer term bearish. Unequivocally, I'm longer term bearish. I actually, though, have it in my mind that we may explode up. Okay, for the shorts to puke before we actually come down extraordinarily hard. I don't mind saying that. I don't know which way it's going to play out, but I'm going to tell you the short opportunity is huge. Now, okay, with that being said, here's one interesting thing I do want to show you. When I talk about, this extraordinarily narrow range, yet volatility, okay, and then you look over here at VIX and you're like, the VIX is terrible. Okay, the VIX it's not worth anything. It's 30-day volatility, yada, yada, yada. Okay, but the VIX is not explaining, all right, and what you're not seeing inside of the VIX is really how crazy we're really getting. And I'm going to show you that by going back to this 30-day 1 hour. Check this out, right? So we're going to come here, and for those of you that do speak more technical analysis, again, I'm not much of a chart guy, but I do know an average true range when I see one. Okay, look at the average true range. In fact, I'm even gonna get rid of the volume here so you can get a really clean take on average true range, right? And on this average true range, I'm even gonna drag it up over here. Ah, yes, this is what I want you guys to see. The average true range, right? And this is a 30-day 1 hour chart, this is an ATR Wilders averaged over 14, but 14, the period is set to hours over here. What you want to see is nothing going on, nothing going on, nothing going on. Uh-oh, we're getting huge, okay? The waves are getting big. And the last time we actually saw outside of huge, we were outside the range. I just want to make that that brief and very subtle point is, something changed. All right, and we're ready to go. Now, let me actually bring you back a little further over here. That's the, now we're going to go to a 90-day 1 hour. Again, we're still on a 1 hour chart, but I wanted you to see that everything here is inside the range. Everything here is inside the range. Okay, and all of a sudden, the ATR really, really picked up. And again, usually I'm not much into the ATR, but the kind of action we're seeing right now is the kind of action we saw when markets were actually all over the place. So heads up on that particular front, because the waves are about to get big. You can see them coming. So as I was saying earlier, you have the Fed. Okay, Fed actually raises rates, yada, yada, yada. No one really cares. The Fed actually left us in quite the ambiguous place. And they left it ambiguous because, well, that's what they're trying to do, trying to stave off traders. We might raise rates again. We might pause. We might raise rates or pause, but we're definitely not going to cut rates because we're going to raise rates or pause. Anyway, the Fed's up. Jobs number was actually pretty good. Market didn't really have much reaction to the jobs number. Apple, okay, what do you think's going on here today? This could actually be dubbed the Apple rally. Oh, maybe. Apple's up to the tune of almost 5%, a little gap to the upside. The cool thing about Apple, and it is kind of cool from my point of view, you realize Apple's actually just a hair off of its all-time high. That's one I did not think I'd be talking about again for years. And the reason I think that's kind of cool, oh yeah, I'm actually short in there. I'll talk more about that. Okay. It's not often when you see a stock exploding to the upside and the person talking about it's like, yes, I am short. Okay. Are you kidding? I like this. I'm not even fully allocated into it. I like it. This is when things start to get opportunistic at this point. Anyway, so the Fed up, the jobs up, Apple's up, but ironically, yeah, no, the market's actually going to finish the week. As I was saying here, let me delineate this very, very clearly. This is your trading week. Okay, we started here and now we're here. For those of you that are market technicians, here's about we started the week somewhere around 4170. And we're just a hair lower. I mean, I like to say after all that volatility, we are massively unchanged. If you look at the QQQ, okay, in terms of the Qs are actually going to finish the week just ever so slightly higher. Take a quick glance. Actually, right now, the Qs are massively unchanged on the week as well. Products like financials, they got smoked. They're outside the edge of their expected move. Energy sector, oh, you got to look at the energy sector. The energy sector's come back. The energy sector is still a 2 standard deviation move lower. Okay, and one of the points I want to make with this one is that you try to be as objective as you can. And I said, like, don't necessarily assign any directional bias, but you do have to realize, okay. When this range breaks, first of all, the market's going to get downright nasty. It doesn't matter what direction you think it's going to go in. It's going to get downright nasty. Okay. Everything right now, and I mean everything in this marketplace belongs to tech. If not for tech, you'd be completely and totally, well, skewed. We're going to talk about skew in a second. Okay. Tech is the only thing holding us together right now. You start to look at stocks like Meta, raggy. That's not really holding us together, is it? Okay. Most of the other major tech stocks, though, that's it. You got nothing but mega market cap. And as I showed you a moment ago, and I was kind of setting up for this, but the energy sector is already getting decimated. I mean, what are your biggest sectors out there? You've got energy, you've got financials, and you've got tech. Well, you want to talk about what? Oh, consumer staples. Consumer staples aren't going to do anything. Right? There's no market cap behind this. Consumer staples can rally all they want. On a year-to-date basis, they're up like a whopping 3%, but they're not going to do anything. They're not enough to move the marketplace at this point. You got the financials, they're down and out. Okay, you got the energy sector, it's down and out. You got nothing but big market cap. And guess what? Earnings are over. Okay, earnings are over, and it's things are going to get interesting over here. The range. Okay, back to the S&Ps. The range, it's just the range that defines everything. Breaking this range, okay, is going to be, again, kind of critical mass, because if not for tech, we would be actually in the absolute dumpster of a marketplace right now. And the market really is a little bit of a dumpster fire. The only thing holding us together is the fact that Apple, at this point, you do realize we're approaching almost a $3 trillion market cap. And when you start to think about, it's 2.75 trillion. Okay, the magnitude of Apple. Okay, Microsoft, Apple, basically Amazon, Google. I don't even put Meta in there. A little Tesla, maybe NVDA. NVIDIA is actually a huge market cap these days as well. By the way, NVIDIA, can't discount this one. Okay, NVIDIA is actually approaching the $1 trillion mark. Anyway, you put these things together, and what you basically have, it's its own marketplace, and that's what's basically sustaining the S&Ps at this point in time. And I think it's opportunistic. The other aspect that we want to think about is volatility. A lot of people are talking about volatility getting crushed and crushed down. Okay, nevertheless, as volatility is getting crushed, SKEW is actually picking up, and it's really going to pick up today. I actually did execute the sale of a call option today because the SKEW was really, really heavy. It was a very interesting trade. I'll explain more about that on Monday, but it's not usual where, you know, one day of a rally that I'm selling a call into it. But again, it was very advantageous to sell a call. But SKEW, okay, there is the closing bell. Okay, look at this. Week finished, okay, for the most part, massively unchanged. But SKEW looks like it picked up quite dramatically today. Again, I'll explain on Monday why I sold calls into a heavy SKEW, because SKEW usually is what? It's picking up the out of the money puts, not the out of the money calls. Again, much more of an explanation on Monday on that particular front. Anyway, okay, you got to see that this range defines everything. And obviously, the next week of trade, well, next week of trade is actually going to host none other than CPI. So once again, we are going to be just this, you know, powder keg of risk, largely predicated, you know, movement is going to be, you know, well, it's lighting a fuse every time something comes out. CPI will be out. Okay, there's a couple more announcements, a few more data drops over here. It's going to be a little bit of a free for all. And one of the things, though, that really surprised me, and I'll talk about this also right at the end of the video, is that implied volatility next week. Okay, you would think all of the stuff that went on this week, you had the Fed, you had the jobs number, you had Apple, except we had a $72 move this week. You realize that next week, and this one's almost hard to explain, next week we still have a $68 move. Okay, and you're like, wait, what? Okay, even after everything that we've been through this week and all this extra implied volatility was packed in, next week still has a $68 move, which again is implying something. It's implying this marketplace is definitely baked in and ready to go. It's ready to make a more substantiated move. Cannot stress for the last time over here, this range, and now we're going to start to talk a little bit about some of the trades. This range that kind of defines us right now is again, in my opinion, it's just ripe. It's hitting critical mass. We're ready to actually break through the range. And when we do, okay, look, when we talk about get your trade on this week's profits and losses, the most important thing that I can emphasize is not trying to handicap which way we're actually going to crack, higher or lower. There's no question that I am substantiating positions, okay, that are much more of the investment type. I'm substantiating positions saying like, look, okay, I say longer term, we're probably going to go down. Longer term could be anywhere, you know, 2-3 months, even more out. And I'm actually building positions, okay, for just that. So short term, I actually throw my hands up and say, look, this is going to be a very binary move in the short term. Binary move basically means we're going to explode higher, we're going to explode lower, right? Okay, that the move is impossible to handicap here in the very near term. Longer term, that the market progresses not just lower, but significantly lower. And in this week's Get Your Trade On, we talk about like profits and losses and the range that kind of defines us all. Look, the single biggest trade, and I went after it this week, okay, is in Meta. So I have really bared up in Meta, and I'm not usually so adamant about something, but in Meta, there's a couple things I've done. Number one, I am outright short stock. Okay, I am short stock. I'm in a portfolio margin account. Screw it, I'm short some stock. And after everything in Meta's exploded to the upside, and you're like, oh, he's got to be getting killed in there. Okay, I'm not getting killed in here. I'm only short about 200 shares in this particular account, but I am upside down. Okay, and I'm upside down by the tune of about 12%. That's this last gap to the upside. The biggest positions, though, that I put on, okay, are positions out here. I went out and bought put spreads, out of the money put spreads, and I financed those put spreads, okay, having sold S&P puts. And I did those, okay, time and time again. And I actually put those in a couple of different accounts in a couple of different ways. Here's actually a few different positions in Meta. This actually has to do with the Catapult portfolio. So I actually am out there again, anywhere from the 225, 215, 220, 215 spreads. Okay, so when I say anything under like 215, and I am absolutely golden, I think that we're actually going to cover through this gap. All right, and that's spreads that I paid like $2.30 for to be able to make as much as between like it was $10 wide spread you pay $2 for. Okay, you can make anywhere between $7 and $8 on those particular spreads. So again, I am short in Meta and short in a very big way. I've given myself though ample time on those spreads. The spreads are not for tomorrow. Okay, I want to make that very clear. I've actually got spreads that are all the way out 77 days in most cases. All right, onward and upward. That's one of the biggest trades, though, that I really wanted to emphasize. And it's, as I said, it's very rare because, again, in my opinion, Meta is absolutely ripe and finally started to roll over after this most recent earnings. Anything, in my opinion, that you're willing to sustain, okay, for, 2, 3, 4, 5 months of time, if you can sustain shorts, Meta, NVIDIA, Microsoft, okay, make no two ways about it. I'm short all of them. I'm absolutely short all of them. Positions in Microsoft, which I've actually amplified to some degree. I'm short just 300 shares now. This is just one account. I am down by 4% in that one, okay? NVIDIA, I am just now on the bleeding edge of reshorting NVIDIA. For those of you that do not know, I've had a storied history inside of NVIDIA. NVIDIA up $11, a 4% move to the upside today. It's exploding to new levels. Again, as I said, I've had kind of the story career inside of NVIDIA. I started shorting NVIDIA in the mid 200s, rode that thing all the way up to almost $350, built a sizable position, took it all off in the 150 range. Okay, some huge positions in the past. Here we are again. I've only started very mildly. Okay, I believe I'm short at the $260 range at this point. So I'm short at 260. We're trading 286. This is one where I'm going to start to build, again, a much more significant position. Meta, short. NVIDIA, short. Microsoft, short. Why? Because I think that, again, with big tech holding us together, what else do you have? Now, I've got short positions inside of Apple, but that, okay, those are positions I've substantiated for a significant period of time as well. I am underwater on those. That is not one that I'm actually stepping in and shorting right now because Apple is so close to its all-time high that it's very likely to pierce through the all-time high before I would actually step in and short it. Meta, NVIDIA, Microsoft, though, feel very differently about. All right. Last thing I want to mention on this particular front in terms of get your trade on. Again, we've talked extensively about this range, and I had mentioned inside of the S&P futures. And again, this is fairly critical because I'm going to get a lot of emails, a lot of long talks about this, but the range here is an incredibly dangerous one. And what is so dangerous about the range is if we do come out of it, and again, there's no telling exactly when we're going to come out of the range. If we come out of it, there's going to be a little violence inside your trade. And one of the things that I came up against, okay, twice recently is we came down hard, and I did not sell out of the money puts. And I got pressure from everybody. Come on, man, you got to sell some out of the money puts. No. All right, I'm not going to do it. I'm not going to do it until I see what the other side, okay, of 4070 actually looks like. Because, again, I got to tell you, these levels, just this 4106 is critical. But somewhere, as I said, somewhere in the neighborhood of this 4070-ish inside of the S&Ps, it's not just critical. We could actually turn into an absolute fun fest to the downside going through there. And, I don't feel like, this imminent need to allocate in the midst of an absolute firefight, because that's exactly what the marketplace will turn into if we start to cruise under that level. I mean, one of the things that I saw, okay, in this week of trade is getting down to these levels. Here's actually a 4060. There were massive, unrelenting volume spikes down here. Forget this move to the upside over here. Massive and unrelenting volume spikes through and through, and it's intimidating, and I'll tell you exactly why. And most people are not going to pick up on why it's intimidating. Those volume spikes, okay, at those levels, somewhere around, again, that 4070-ish, 4065, yeah, it's indicative of a lot of proprietary trading firms, a lot of, funds and so forth, and market making firms. All their servers are turning on, okay? They're turning on and actually hedging heavily right and around that range, and that should intimidate anybody. It should intimidate you because they're actually turning on, they're having to hedge, which means under that level and somewhere under that level turns into a little bit of a free-for-all. All right. I mean, I'm ready to execute. I'm teed up and ready to actually sell puts. And we hit that level and I saw the volume spikes. I go, yeah, I'll let that one go. Let that one go by over there. So if you're not feeling the fear, you should, because I'm going to tell you right now, that's the dangerous heavy volatility and an incredibly narrow range. When we break, we're going to break big. Last but not least, as I said in the SPX did in fact breach did breach the lower edge of the expected move, came back significantly. We still ended the week, and again, I want to reiterate, we still ended the week, okay, from 41.70 down here to 41.36, so we're absolutely lower. The thing that really kind of surprised me again is that, with a $72 move priced in for the week, okay, we had multiple days when we moved more than $72, but here we are looking at next week, and next week is still pricing in almost $70 move, right? Basically means, yeah, you got to keep the helmet on. As I said, we've kind of hit like critical mass of this particular range. I think we're ready to rumble. Get ready for some big moves this next week of trade. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.